What's up, guys? Welcome to another deeper dive of SBUX. Now, most investors look at companies from a 10,000-foot view. I like this company. I want to own it. I go buy it. That's not enough. Mo and I do more of a 50 to 100-foot view. So that's at the end of the day. What we're trying to do here is a 500 to 1,000-foot view. We're going to use our 8-pillar process to look at the company, ask ourselves questions, maybe search in a 10K and other opinions on the internet to get some information to decide. The point is, as we pull back the layers, we're going to decide, do we want to go deeper or not? So we're doing SBUX today. Mo actually has a SBUX today.
I do, and I don't think we need to go any deeper. I think we're good because Jim Cramer on SBUX,
no.
I'm all in.
In fairness, that was 5 months ago, and you saw the video
Today
about
he's
him.
shorting. I played that on the morning show.
What was that one again?
It was NVIDIA.
NVIDIA.
It's going to be a $10 trillion company.
And then 5 months later, he was like,
it.
we're shorting it. We're shorting it. It's a bad company. All right, so let's do a SBUX look. I'm going to do the 8 pillars first to start. Mo's starting to get some ideas of what people are saying about SBUX. I have my ideas on what questions I want to ask. So let's dig in a little deeper. If you have our software, of course, it's a great way to learn how to use the software. SBUX is even today in a big up day. $112 billion company. Enterprise value of 145. So that difference is roughly the debt involved in the company. Mo, what were you going to say? Nothing?
I wasn't even looking at you.
Great.
Sorry.
Revenue of 31 billion.
At some articles.
Gross profit of 26%. Bottom line in the last 5 years of 11.4. Last year 10.1. So a little bit lower. Dividends of 2.25 billion with a 5-year average free cash flow of 4 billion. So it's a big chunk. I like that number being south of 50% of the free cash flow. And last year's free cash flow is a lot lower than the last 5 years. So, okay, not the best, not the worst.
Mm-hmm.
Let's go to our 8 pillars. Oof. Mo, did you see these 8 pillars?
Oh, wow. I would not expect that.
Yeah,
Just
so
thinking about it as SBUX, I would not expect this.
So some things I don't like. Buying back a lot of shares with high PE and high price of free cash flow.
Yeah.
All right. The debt doesn't worry me because it's a lot of retail,
Yeah.
a lot of leases in there, things like that.
So that net income number, I have to think that's...
Let's go look.
Yeah.
So why
check
is net
that out.
income down in the last 5 years? So revenue in the last 5 years is up. Net income is down.
It's kind of back to what it was.
Yeah, so this is why we like to look at long-term averages. Because you look back and there is an uptrend, but there's a lot of volatility in that uptrend for an average of $3.2 billion. Now, I think I remember SBUX saying they're going to close locations. So one of the first things I want to do, 1, find out how many locations they have. 2, what's the same-store sales growth of the last few years, okay? How have they grown same-store sales? Not how have they grown sales because they open 1,000 more locations, right? We want to sit there and see how are their same-store sales going. Mo, are you in the 10K right now?
Yeah. So they in North America, they have 9,861 stores. And then globally, 17,133.
So a little over half.
Stores.
That is a lot of stores. How many are closings? Oh, wow, they're closing a lot. Net, they're opening 500 stores
Correct.
over the year, and they're going to, okay.
Yeah.
All right. That's what they did in that year. When's their year end?
October 3rd, 2021. So October 3rd of it ended.
So they probably have they don't have the new 10K out?
That's not, this is what the one that displayed for us.
For the SEC? Wow. Okay. Let's look. Let me go back here. Let me look at analyst estimates. Mo, can you pull up same store sales by chance in the 10K? So here's analyst estimates, guys. Boy, actually pretty good. Almost doubling their profit EPS in the next 4 or 5 years. Again, one thing I don't like is buying back shares can manipulate this to the plus side. But what they're doing when they buy back expensive shares is they're taking your money that you have a right to and investing it at bad rates of return. I don't like that. It's not a good use of capital. That to me is poor management. I want the company to be buying back shares when it's obscenely cheap, like sub 10, single digit PE and single digit price of free cash flow. That's a super cheap. Now they're probably arguing like, well, we pay a healthy dividend. We save that dividend, blah, blah, blah. It helps our cash flow. I get it, but please don't. Revenue growth. Very little revenue growth. Actually, it's actually pretty good. About 10% a year. All right, 4-year period. Yeah, about 10% a year. From 33 billion to almost 50 billion. Okay, not bad. So Mo, did you find anything on same store?
Same store sales.
What about comparable?
It did say same store sales declined, but it didn't. No.
How many? You have 48 matches for COMPR.
Comparable.
Nope. Okay, let me start. So guys, this is part of the actual hard part of reading a 10K. It's actually finding some of the data. Now, some people would say you must read the full 10K. I get it. I don't know necessarily if I'm going to read an entire.
For North America, comparable store sales increased 22%.
Well, that was because of COVID, I imagine.
Yeah. So exactly. We lapped higher costs attributable to COVID-19.
Yeah, because 12% decline in fiscal 2020.
Mm-hmm.
Okay. So it'd be really interesting to see how their store sales have gone in the quarter. So let me go back and look at their 10Q for August 2022. I'm looking at that right now, Mo. Comparable store sales, our global comparable store sales grew 3%, primarily driven by 9% growth in the US. Okay. Leading 44% decrease in China comparable store sales because of the restrictions in China because of COVID still going on.
And that's actually, I was just skimming the 10K. That's a lot of things, especially in their risk factors section, is worry about China.
What percentage of their stores are in China?
Let's go back to where that was.
So these are the questions I'm asking. Like, okay, 44% decline, 3% growth worldwide. But if China
has 4,000.
So a third of their stores.
Yeah.
So to me, guys, I'm not worried. This is going to be much higher because China is a third of their stores almost, and they declined 44%. So I'm looking at this going, okay, I'm not worried about that. That doesn't cause me concern. It goes, okay, it's hopefully an anomaly. I mean, 5,000 stores in China.
Yeah.
And guys,
almost 5,400.
So how many stores in the US?
9,861.
Okay, so we have 330 million people in the US. That's an average of 33,000 people per store, 30,500. China has 1.6 trillion. It's every 300,000 people. So that if China keeps growing like it is and the economy keeps growing and the middle class keeps bigger, they can get 9 times more stores in China to be the same penetration as the US. That shows the potential in China just for Starbucks. Now, is that apples? No, but let's say it's 4 times more. That's still a lot of stores. That can grow their stores by another 20,000 stores. That's where a lot of growth potential will come for Starbucks.
Yeah, and the bear cases.
How many are in Africa?
The bear cases that I'm reading about Starbucks is all about China.
Is there any in Africa?
Japan, UK, all other retail 65. So
how many in India? Now, I don't know.
Break it down here.
I don't know if there's restrictions on this, but I'm just trying to show like Starbucks is a very mature company, but there's still a lot of growth potential as the company gets larger and larger and larger because the world gets larger and wealthier. And Starbucks has proven to be a luxury item that people value. And a lot of countries worldwide like coffee. Now, the question becomes, do they sit there and say we're going to shun Starbucks because we have our own coffee? Very well could be. But the point is, there's a lot of potential there. All right. What else you got, Mo?
I'm not, based on what we've seen right here, I'm not worried about the China stuff because it's going to rebound. Once I get over the zero COVID policy, I think it'll rebound and that'll be fine. I like from what we've seen on the income statement, how they're kind of coming back to reality after that big boom that we saw. So these are good things so far that I'm seeing.
Yeah.
I like the same store sales are increasing. I like that they're being proactive and closing stores that were not doing well and putting them in better locations.
And here's, by the way, a breakdown of the comparable store sales, a 6% increase in average ticket. What's that called? Inflation. Offset by a 3% decrease in comparable transactions. Unfavorable currency translation. Okay. Licensed store revenue was up $277 million. Okay. Now I wonder here, like look at licensed stores revenue, Mo, for the quarter, up 40% versus corporate stores were 55%. My guess is a lot more stores open that were licensed stores versus corporate stores.
One concern that just popped into my head.
Yeah.
Unionization.
Oh yeah, they're going to do that, aren't they?
A lot of stores are doing that. So that just put a damper on my parade, maybe.
Well, listen, Starbucks is a commodity. Yeah. Starbucks is a luxury commodity. People are willing to pay for it. Maybe they can offset those costs because for those of you out there who don't understand, increased labor costs will increase your cost for the item. That's it. And if you're okay with that, and if you believe in unions, you should be okay with that, then go pay $18.40 for a cup of coffee all day long because you'll probably end up paying that at some point.
Yeah. This is $4.65.
What was that?
This was $4.65.
Was it really?
Yeah.
You know, I love the peppermint hot chocolate.
It is very good.
All right. Product distribution costs. Okay. So here are the costs for the last 2 years. It was, let's see here. So we're going quarter ended, an increase in costs in terms of net revenues, an increase, could be inflation. Store operating expenses up a lot less, makes sense because fixed costs for rent and all that stuff. Depreciation, restructuring, impairments, about the same number. G&A, actually down. General administration expenses were actually down. That's cool. Operating income was also down as a percentage of revenue for the 3 months. For the year, also down for the 3 months. Sorry, this was for the quarter. This is for 3 quarters ended. All right. So listen, guys, this looks like a company to me that I would want to own for the long run.
Yeah,
the question is
for sure.
The question is,
what price do we pay?
Yes, what price do we pay? Average store. Nope. Let me see. Is there a place that talks about average store size? Operating lease. Okay, so they have an average of 8.7 years left on their leases right now. Okay, that's something to know. So a lot of the stuff, guys, is stuff I don't really care about currently. I'm now at the point where I go, okay, I'm liking what I'm reading. I think there's a lot of potential. Like if somebody said to me right now, what's Starbucks potential worldwide? I'd say, well, they have 5,000 stores in China, and it's an average of 1 every 300,000 people. In the US, they have 1 every 33,500. So there's a lot of potential in China alone. We haven't touched India. We haven't touched Africa. And I don't know if those are really places that might, but I would have never guessed China was. Go ahead, Mo.
Something that I did want to look at, because this is it's an expensive item to go pay almost $5 for a cup of coffee. So I wanted to go back to the last recession. They didn't really have many issues going through there. This was 2008, 2009. I just highlighted 2008 through 11. Not a lot of issues.
So how many stores they have back then? I'm going to look up. So what year was that?
And that was 2000. Look from 2008 going into 2009.
Okay, so.
And net income during that time fell a lot in 2007 to 2008.
They don't go that far, but I'll do 2011.
Boom, back in 2010.
2011, 10K. Boom. So total stores. That's what I'm looking for. All right. In the US, total as of October 2nd, 2011, 17,000. How many do they have in now? 17,000, right? So guys,
wow.
It looks like so their revenue was what back then?
Their revenue was
10 billion. And what is it now?
Now it is
31 and a half. So guys, they've tripled their revenue on the same number of stores.
Yeah.
Oof. Yeah, that just shows people are willing to pay. And I'm quite sure, same number of stores, they've tripled their revenue.
Inflation.
All right. So, by the way, guys, look at what I'm sitting here saying. I'm looking at going, okay, how many? I mean, this is to me a very obvious thing of like people are willing to pay more for this luxury item. They love their Starbucks.
And in bad times.
I'm actually surprised. I thought it was going to be like 10,000 total stores.
Me too.
I really thought it was going to be 10,000 total stores.
I thought it was going to be less.
Really?
Yeah, I thought it was going to be less. That's wild.
That is wild. All right, so let's go to our stock analyzer tool because I think it's time now to see, should we spend any more time in the company? Because remember, you should not spend all your time doing research. You should find the companies that make the most sense. Now, if you have our software, I recommend pause the video right now, put your own stock analyzer assumptions in. That way you're not biased by what we say. Then press play and see what we say and see if it matches up. So,
wait a second here.
Yeah, go ahead.
You said that was 17,000 stores in the United States?
No, total.
Okay.
Yeah, total.
Okay, good.
So back to analyst estimates, they had revenue growth of basically double digits over the next 5 years. So I'm going to, oh, wow. But revenue growth of the last 10 years was 5.7%. All right. So I'm going to do 3, 6, and 9%.
Okay.
That's high, 9%, but I'm good with that. Profit margin, 10, 11, 12. Free cash flow margin, I'm going to do 11, 12, 13. Now, PE and price to free cash flow. Guys, it's Starbucks. It's awesome. It's great. It's wonderful, dandy, but it's still a big company. So I'm going to sit here and put 14, 15 and a half, and 17. What do you think, Mo?
That's fine.
Desired annual return. Guys, the bigger the company, but I've made very conservative assumptions here. I'm okay going with, remember, you can get 9 or 10% from a low-cost ETF that you have for a long time. So to get some sort of margin of safety, and to give yourself a reason to buy the company, get a higher rate of return than that. And the higher your assumptions as you go along, the higher your desired return, because it's a bigger margin of error, margin of safety. So I'm going to go 12, 14, and 16.
Okay.
hit the analyze button. Now, the stock is currently at 98 bucks. It's on my watch list of 55. I have a low price of mid to high 30s, a high price of high 50s, and a middle price of somewhere in the 40s. Now, does this mean this is absolutely it? No, this is the art of investing. They have a reasonable return on invested capital. It's a great brand. It's got a lot of growth potential. Am I willing to pay a little bit more for it? Sure. Like I might actually think here right now, I might change my my watch list price to 60 bucks. Because I'm looking at going, that China story really makes a lot of sense to me.
For sure.
So I look at this going, okay, let me add it to my watch list. I'm going to change this to 60. So guys, if you like this video, all I ask you to do is one thing. Subscribe to our channel. That's it. Very simple. Please do it. You're going to love it. If you watch 4 or 5 more videos, you'll have a better understanding of money and investing. Because remember, the more you learn, the less you fear. Thank you very much. Take care. There are 3 things that you absolutely need in order to be a successful investor. The proper mindset, the proper emotion, and the proper process. Which ones are the most important?